All right, so why do investors sometimes want a down round to occur? I would say investors generally don't want down rounds in their companies to occur. So it's a negative thing for a venture capital fund to have to write down the value of the companies and the stock in its portfolio. It makes their performance metrics that they have to report to their limited partner investors look worse. So it looks like they're losing money, which they are on paper for the most part. The down round conversion math helps alleviate the impact of this to an investor to some degree, but not all the way. There's usually a write down feature. So it's usually not anybody's, no one's really usually happy about a down round scenario. Why might a company do a down round? It's really a risk adjustment mechanism to either compensate investors for taking additional risk in a really tumultuous or uncertain market. It is also a way for the company to get through maybe a hard time where it missed metrics, but things are overall still working enough for the company's investors to feel like they can still support the company. So there are various reasons why a down round happens, but I don't think anybody is generally celebrating them. And I do think that they're more common than they have been in the past. I've been seeing a lot of either flat rounds or down rounds with some of these things, and it goes in cycles. In 2008, 9, and 10, there were a decent number of down rounds happening for companies, and some of those have gone on to do very well and exit, so it's not the end of the world. And then there were a little bit in 2014, 15 that I kind of noticed, and now again we're seeing quite a bit. So I think that as the market sees a lot of uncertainty and volatility, VC investors also become a little bit more cautious, and you'll see down rounds occurring more frequently than not. But again, the down round doesn't fully ratchet any investor to what they would have had you sold them stock at a lower price per share as you're doing now. It usually is not going to entice a new investor to come into the round. It's usually there to get the support of your current investor. So I haven't seen that many deals in my experience where companies have done down rounds and found new money. Now, on occasion, there's an investor out there that's been waiting in the wings and says, I didn't think your price was right, but now I think it's okay, and I'm going to come in because it's lower. However, I think those kinds of investors are either, fairly inexperienced, because to most new investors, a down round is kind of a negative signal. And then number two, that investor in particular might be on the more opportunistic side, and you just want to use some caution. In other words, they may be looking for opportunities to sort of, come in opportunistically, and they may be looking for weaknesses, maybe to acquire the company down the road or something. It's hard to prejudge those things, but in general, if you find yourself in a down round situation, I think it's still pretty hard to attract new capital other than from your existing investors. I do not think it brings a lot of new investors generally into a deal. So that's a couple things about how these down rounds come into play and how they're used, and what the impact to a company is in its fundraising strategy. If the company needs to attract new investors, then it may need to recover and get back on more solid footing, or may need to let the economy take a turn. So, for those founders who are out there thinking that a down round or more attractive terms will get people waiting off the sidelines and into the company so that it can achieve its bigger fundraising goal, I think that this is a fool's errand. It's almost certainly not going to work. However, if you redo your budget, if you redo your priorities to solve whatever problems will make the company, leaner, meaner, able to get through these difficult times and come out the other side in a very sure position with the funding that's available from your existing investors, then that's where I think the use case for the down round makes some sense. But I don't know that it's necessarily a good idea to attract new capital, and I have not seen that really succeed. If you like our content, I hope you subscribe and like this video. And certainly, we're going to be doing more on these and other topics, so stay tuned. Thanks.